The infrastructure funding gap is the headache that bedevils governments all around the world, and it's the difference between what a country needs and the public funding that's available. Governments striving to meet citizens' expectations, it means a global race to find alternative forms of finance. Hello, and welcome to Talking Global Infrastructure, a podcast from the Global Infrastructure Investor Association. I'm Simon Montague, Director of Corporate Affairs, and I'm delighted that I'm going to be joined by two people from Freshfields, the law firm. First of all, with me is Jessamy Gallagher. She's Global Co-Head of the Energy and Real Assets Group and a partner in the Energy and Infrastructure practice based here in London. And Jessamy, you focus your practice on international public and private M&A in the infrastructure, energy and real assets markets. And you've also got extensive experience in counselling on business-critical corporate governance matters, with your clients being among them a range of private capital investors, global pension, infrastructure and fund managers, as well as some FTSE-listed companies. So you're very welcome. Hello. Also taking part is Alastair Mordaunt. Alastair is Global Co-Head of Freshfields Foreign Investment Group and a partner in the Antitrust, Competition and Trade Group. And Alastair, you've got more than 25 years' experience, both as a private practitioner as well as being a regulator across 3 different continents, focusing your practice on helping private capital investors steer their global deals through complex merger control and foreign investment regimes. So you both sound incredibly well qualified for this conversation. Alastair, welcome to Talking Global Infrastructure.
Thanks, Simon. Delighted to be here.
Good to have you both. Now, let's get started on this new report called Competing for Capital. Jessamy, perhaps I might begin by asking you, first of all, what do we actually mean by the title of this new report, Competing for Capital?
Thanks, Simon. Great first question. When we talk about competing for capital, we're describing what we see as a very real global dynamic. And that dynamic is the fact that governments need access to huge amounts of private capital to fund infrastructure, whether that's energy transition, the digital infrastructure space, transport, network renewal. The list is long, but the capital itself is global, it's mobile, and it's highly selective. So I guess to put the dynamic in very binary terms, the reality is that governments need capital, but capital itself doesn't need any particular market. And the way that investors make their decisions is very disciplined. Ultimately, we see our infrastructure investor clients making very careful portfolio allocation decisions. And the way they go about that is to compare jurisdictions, and they ask what we would say are 4 very practical questions. And those are, is the framework stable? Is there a visible pipeline? Can the projects actually be delivered? And am I being paid appropriately for the risks I'm taking with this investment? And of course, quite logically, the capital then tends to flow towards the jurisdictions that are able to answer those questions most convincingly. And I think we'll dive into this further, but one of the very interesting findings from the report is the fact that there's so much convergence around those questions. And we see regions as different as the UK, Germany, Australia, Canada. They've all broadly arrived at the same conclusion as to what private capital needs. And that's to reduce merchant risk, to use public capital to bring in private investment, and ultimately to make projects quicker to build. And that tells us something very important, which is that the infrastructure investment community has actually been very effective in communicating what it needs to governments. And governments have largely been listening to those messages. But just because everyone agrees on the toolkit, we would say doesn't mean you get a convergence in the outcomes, because capital still has to make choices. It's still comparing different countries, and it's asking where the framework is credible and where it can commit capital over these very long investment periods, which might be as long as 20 or 30 years.
So are you seeing that having an impact on M&A flows?
Yeah, Simon, you can see that really clearly in M&A activity. And I'm going to focus on the UK because that's where I'm sitting. And I'm very positive about UK M&A in the infrastructure space, despite some of the wider turbulence that we're seeing. So, for example, in the last few months, we and the team here have been involved in some really significant UK M&A infrastructure investments. We've seen GIIA Infrastructure, who are one of the big global investors who've bought into a major UK smart metering portfolio. And then, of course, you've got EDF and others investing in Sizewell C. And we've seen EQT come into Yorkshire Water. So these are very significant, very large international infrastructure investors coming into big UK assets. And I think that tells you three things about the environment in the UK. There's confidence in the long-term demand here. There's comfort with the regulatory framework. And there's a real belief in the UK as a place to deploy capital at scale. So ultimately, to come back to the original question, when we're talking about competing for capital, what we're really asking is why does capital choose one jurisdiction over another? And I think we're seeing that come through very clearly, at least in the UK, and we'll talk more globally as we go on through this podcast.
Well, perhaps, Alastair, I might pick up with you, thinking about competing for capital in practice, as Jessamy has been talking about. And perhaps this is a two-part question in a way, but how does the international race for private capital actually translate into policies, and how do these policies then influence the relevant merger control and foreign direct investment regimes?
Yeah, it's a great question or set of questions, Simon. I mean, I think there is some inherent tension here between the policies that are implemented by governments to attract this capital on the one hand, and then some of the regulatory intervention tools that we see, such as merger control and foreign investment screening, which is what you mentioned, and essentially that tension is coming from, on the one hand, government policy. And on the other hand, these independent regulators who might be somewhat influenced by government, but they are essentially independent and not necessarily looking at a long-term horizon from a sort of strategic investment perspective. But I don't think it's all tension and doom and gloom. Take for example the UK, which is incredibly conscious of the need to attract investment, and we've seen that particularly since Brexit. And if you look at the introduction of the UK's foreign investment or national security screening regime under the National Security and Investment Act back in 2022, that piece of legislation, on the one hand, was trying to screen certain types of investment and potentially stop those investments. But at the same time, the government was at pains to say that the UK is fully open to foreign investment. And so there is that trade-off between, on the one hand, what's appropriate regulatory screening, but at the same time, welcoming as much investment as you can. And we've actually also seen it on the merger control front. The Competition and Markets Authority introduced what it calls its 4Ps policy last year, which is ensuring pace, predictability, proportionality, and process, and sort of baking those principles into its review of M&A deals in the UK. And that was very much a direct response to investor and broader stakeholder criticisms that the CMA regime was unpredictable, that it was burdensome and disproportionate, and was potentially deterring investment. So you can see that there are good examples where actually the regulatory tools are actually aligning with those broader government policies, and that the report looks across a number of jurisdictions assessing these types of issues.
Yes, you mentioned a number of jurisdictions there. And just for people who are listening to us and indeed perhaps watching us as well on YouTube, the report does cover 10 jurisdictions around the world, and I'll list them all quickly, but there's Australia, Canada, the United States, the UK, as we've been talking about, Germany, France, Spain, Italy, the Netherlands, and the European Union as a whole, chosen because, of course, they are among the biggest markets for private infrastructure investors. Another issue that the report does raise is what it calls, or what you have written as it calling it, the persistent challenge of regulatory stability and retroactive risk. And indeed, that makes me think of when actually GIIA itself was founded on our side 10 years ago. And that followed two incidents of investors being hit by retroactive policy changes. One was in the solar sector in Spain, and another one involved gas pipelines in Norway. Now, both of these incidents were more than 10 years ago. They predate GIIA itself. But there are also more recent examples, such as the UK, shifting from RPI to CPI indexation for renewables obligation payments, And also in the Netherlands, where there's been shifting policy towards subsidies related to electric vehicles and renewable energy production. Jessamy, what have you seen in terms of soft or retrospective risk?
Yeah, thanks, Simon, because I think we kicked this off by talking about what is it that attracts capital into a country in the first place and gives investors the confidence to decide to commit. So the question now is, once that decision has been made, what actually happens post the investment? And that's where the regulatory stability becomes so important. Because it is so interesting that the GIIA itself was born out of those Spanish and Norwegian experiences, which I remember very well, because they illustrate exactly why investors care so much about this regulatory stability. Those decisions had very real economic consequences, and I think they left genuine scar tissue across the infrastructure investment community. I think what our report shows is that the issue has evolved. So today, what we see people talking about is less the explicit retroactive legislation and more about what we call in the report soft retrospective risk. So where changes are legally prospective, but they still alter the economics of the capital that's being committed under a prior framework. And this is where one of the central conclusions of the report really matters. And it's this idea, in a way, that regulatory credibility effectively forms a type of capital in itself. So what I mean by that is investors are not just allocating capital against an asset, they're allocating capital against a jurisdiction, a regulatory culture, and a framework that needs to hold over this very long investment time period. And I spoke about some of these investments, they might be on 20 or 30-year horizons. So when we're advising our clients, they're not just asking us, what do the rules say today? They're asking us, do you believe those rules will still broadly say the same thing in year 15 or year 20 of the asset's life? So countries that are able to offer that stability and that predictability are going to consistently benefit. And again, I talked about some of the UK deals that we've seen recently. Seeing that global capital come into the UK tells us quite a lot about how investors view the UK market, again, despite some of the turbulence that we see around us.
Jessamy, what about the M&A perspective?
Yeah, again, it's got very clear implications for M&A in each of the countries that we looked at, because fundamentally, where that confidence in the stability exists, you see deeper pools of capital flowing, you see more competitive processes, you see valuations at stronger levels, and fundamentally more liquidity. Where you don't have those conditions, then capital becomes selective very quickly. So for us, we see regulatory credibility not just as a policy issue, it directly determines the cost and the availability of capital.
I just wanted to pick up on Jessamy's comments and give a particular example in the UK, which is the water sector, which is obviously a sector that requires significant ongoing investment. But it's subject to quite a lot of regulatory overhaul. So, for example, at the moment, there's a new water regulator that's being established. Under the national security regime that I mentioned earlier, water is being brought into being one of the mandatory notification sectors. And so infrastructure investors have noted that this is going to create multiple layers of regulatory complexity, and potentially deterring rather than attracting investment. And if you then sort of add on top of that some of the political uncertainty that we're living in at the moment with a potential change of prime minister, and possibly impact on future ownership and governance of UK utilities, you can see that has a very real impact, both for future investment, but also, to Jessamy's point, the fact that for existing investors in that sector with potentially very long investment horizons.
One of the key themes that does emerge from the report is the importance of transparency around investment opportunities, and notably the development of project pipelines. Jessamy, I don't know whether you can bring that topic to life.
Yeah, absolutely, Simon. And this is one of the clearest messages we heard from investors, and it's really straightforward. They want visibility. And their perspective is, before, as capital providers, they can even go to assess the risk and structure their transactions and work out how they navigate this potentially quite complex regulatory environment, they need to know where the opportunities are. So at a very basic level, you can't invest in what you can't see. And that becomes very important for international investors. And what we conclude in the report is actually the absence of this very accessible project level pipeline information can now really be seen as a competitive disadvantage in its own right. Because if you're allocating your capital globally, then that kind of opacity creates a friction for you. And where there's a friction, then capital will just flow elsewhere. Again, despite some of the, the sort of headwinds that Alastair noted, I think in the UK we're seeing real progress on that so far as pipeline is concerned, because we've got a national infrastructure pipeline, there is a long-term strategy, and I think that leads to a clearer signalling of where the capital is needed. And I think something like Sizewell C is a great example of that. You've got global capital being mobilised at scale against a very visible and very structured opportunity. And that's very key to these capital allocation decisions, because investors are thinking about, where am I allocating my risk? What kind of clarity do I have around procurement? What sort of revenue model am I going to be looking at? And what's the timing for all of this? And one of the things that we see is actually that transparency, and perhaps not unexpectedly, tends to be strongest in the regulated network sectors. And that's because those sorts of structure processes generate their own form of disclosure. Perversely, that means that in some of the areas where governments really want the additional capital, which tends to be the more greenfields infrastructure or emerging infrastructure, emerging technologies, energy transition, in some cases, that's where the opacity comes to bite. And that's difficult because the capital is needed there, but it will quite rationally either price in that uncertainty, wait until risk has been taken out by someone else, or potentially reallocate to a market where it's just able to underwrite more confidently. So to sum up, I would say the transparency of the pipeline really directly affects these capital decisions and ultimately the deal flow.
And another thing I think we're hearing a lot from investors about is the increasing obstacles and friction in actually achieving deals. And this being caused by the multiple layers of regulatory review. Alastair, perhaps just turning down a slightly different track here, but why does this regulatory maze exist? What's changed? And how can governments actually ensure that this doesn't impede investment?
Yeah, look, it's a brilliant question, and it really has changed probably over the course of the last 10 to 15 years. So previously, investors could make their investments knowing that the regulatory timelines would be relatively short and they'd be predictable, and they were probably only needing to seek merger control clearance, and that was it. And since then, we've seen this huge increase in terms of regulatory tools which are being used by government. So foreign investment screening is one example of that. It's no longer just CFIUS in the US or Investment Canada Act in Canada or the Foreign Investment Review Board in Australia. Or, there'll be over 100 countries now with their own form of foreign investment or national security screening regime. So you can often find yourself as an investor into these sorts of assets looking at merger control, foreign investment review, foreign subsidies review, and then there'll probably be some sort of sectoral regulatory review as well. So it really is multi-layered and sometimes overlapping. And so what's that? That's had an impact in terms of creating obviously much more friction in the process. The timelines have become much longer, and the processes have become often less transparent, particularly when you're looking at sort of foreign investment review, and the outcomes are less predictable. And that's even having an impact in terms of merger control, where it's probably the case these days that those reviews have become much more politicized than they were in the past. So you put all of that together, and there are those obstacles, I think is what you referred to, Simon, that you've got to get over. And the report looks at these different reviews across the 10 jurisdictions that you mentioned. And actually, the headline results aren't all bad. So, if you take foreign investment review, for example, yes, infrastructure assets are routinely captured, and that's because they're considered to be a form of critical infrastructure. But the majority of those assets, when they're reviewed, they're being cleared. and they're being cleared without remedies. So it's creating, a regulatory hurdle, but it's a hurdle that's being got over. And it's a similar situation if you look at merger control as well. So deals are being cleared. Sometimes there are remedies, but even on the remedy side, authorities, I think, are cognizant of the fact that structural remedies in an infrastructure context quite often undermine the value of doing the deal and the efficiencies and synergies that are being sought. So actually, regulators are more willing to consider behavioural remedies, be that access to infrastructure as a potential remedy. So that's all good news because it means the deals are actually getting through. What can governments do more? That they can definitely make sure that these processes are proportionate and that they're targeted. And I mentioned some of those developments in the UK with the 4Ps. The UK authority is definitely trying to make sure that they are making their reviews as efficient as possible. And I think that that's something that we could, no doubt investors would benefit more of if that were happening across all of these different types of regulatory review.
So you've been talking about transparency of project pipelines, the multiple layers of regulation. And of course, as I mentioned a little while ago, this report does cover North America, it covers the EU and the leading member states therein, it covers Australia, and it covers the UK, which of course these days sits just outside the EU. There is a very common obstacle, another obstacle to countries, jurisdictions who are competing for capital, that seems to crop up just everywhere, that wherever we turn in terms of investor thinking, and that's planning and permitting reform. A near universal issue. Whether you go to Australia, North America, the nature of democratically governed countries seems to be that the very protections afforded to citizens also have the impact of blocking the very infrastructure they want, which is a bit bonkers. Your report, you write in it that it's a binding constraint on the deployment of private capital. And perhaps, Jessamy, you can help me on this one. What's gone wrong? Why can't governments fix the issues about planning and permitting reform?
Yeah, well, look, Simon, I think you put it perfectly. It is a paradox of democracy that you've got these processes to protect communities and protect the environment, but they also end up then getting in the way where there is a real need to build infrastructure for those communities. So, as you say, planning and permitting comes up across the board and across the report. What I think is interesting is that I do think governments increasingly understand this. And we see it in the UK, for example. We've got the Planning and Infrastructure Act that came in last year, which is a good example of the direction of travel. But it is not perfect. This is not fixed, and it's really important. And it's maybe just worth pausing on why it matters so much. And the reason it does matter so much for investors is because that risk around time to build directly affects investors' returns. So where you've got a project that faces a delay of a year or 2 years, then that delay of itself can have the same economic impact as many of the other risks that governments have been so carefully trying to address through subsidies and regulations and revenue support. So they kind of cross each other out in a way. So what we are seeing, as I said, with governments increasingly understand, you're getting the legislative frameworks come through. What we see is the challenge around bringing that to life through the administrative delivery. And in virtually every region we looked at as part of the report, there is this gap between what is said in national policy statements and national policy promises and then what investors really experience when a project starts to move through those local planning, local environmental or local permitting processes. And I think one of the areas that we see most affected by it is, of course, data centers, which we hear more and more about hour by hour, let alone week by week. And there you've got these sort of three elements, the planning, the power, and then coming back to what Alastair was talking about around national security, that's overlaid as well. So you're ending up with sort of these different layers of processes that you need to get through. So whilst we do see the direction of travel as being positive, the complexity is just continuing to evolve. To put that in very simple terms, I think if you're an investor looking at one of these projects, let's say looking at building a data center in any one of these regions that we looked at in the report, in addition to all the questions that we've already dealt with around how do I allocate capital and what's the pipeline, you're now having to layer on, will I get planning? Will I get grid access? Will I clear national security? And how do I sequence all of that? And wrapping all around that is how long will it take and what are the impact on my returns? So I think it is an area that capital will continue to focus on. I think governments will need to focus on how they continue to kind of bridge that gap between what they say at a policy level and what investors experience at a local level, because this is all going to determine what gets built, what gets financed, and ultimately what gets traded as part of M&A life.
And I suppose the challenge for so many governments, and the core of this report, is the fact that perhaps governments often only think within their borders. They don't sometimes, certainly our reflection and that of our investor members, is that perhaps officials, policymakers don't really recognise this global race they are in. So let's step back and take a bit more of a global view here, because we've talked about a lot of different forms of obstacles. We've talked about the widely accepted principles that needed to help create a sort of stable policy environment for crowding in private investment while protecting the public interest. So we've got these policy principles that encourage private investment, yet, Jessamy, it does seem to be the case there's still this divergence when it actually comes to policy execution.
Yeah, that's exactly right. There is still that gap. And I think if I was to speak directly to policymakers, I would say, look, the issue is not simply whether you have in place, as part of your legislative regime, support mechanisms and finance vehicles and the tax incentives and all the rest of it. It's whether investors genuinely believe that your framework is going to be durable, stable, executable, and investable. And we are seeing countries take different routes in terms of how they might bring that to life. And I think a good practical example of that is some of the MOUs that have been signed between the UK government and various global investors. And that's then been tied into statements by those investors that they intend to invest very significant sums in the UK. And I think what's important about that is not just the big numbers that end up in the headlines, it's what sits behind those numbers and these sort of broad statements. And I think it's really about policymakers finding opportunities to directly tie in these collaborations between investors and governments and to encourage this better understanding in a two-way direction of the policy priorities. And it also comes back to delivering visibility. We talked about the pipeline, but when you've got these MOUs and you're having these conversations, then you are creating those conditions for visibility. And that all leads to a more structured route for investors to be deploying capital. So I think it's really, a lot of this is about trust and building long-term institutional relationships between governments and these global capital allocators. And I think governments are at different stages of their journeys on that. But I think with all of the regions we looked at, each of them have got some example of having that sort of almost formalized JV or MOU to encourage that partnership and collaboration. And I think that's going to be a very material direction for policymakers to continue on if they're going to compete on certainty as much as anything else.
I mean, it's interesting hearing you talk about that, Jessamy, because if you think about these regulatory tools that are being deployed, they're sovereign to the jurisdiction in question. By and large, it's true the European Commission does look at merger control across the whole European bloc for certain large transactions. But by and large, these regulatory tools are looked at the domestic level. But the regulators do talk to each other. They do have MOUs in place. And so actually encouraging that dialogue to continue and to ensure that people are effectively singing from the same hymn sheet will I think, from the regulatory sort of intervention perspective, also assist in this situation.
Alastair, you mentioned there the European Commission, European Union. At a European level, is there anything else the EU in particular could be doing, should be doing, in its unique role as a regional economic and political bloc?
Well, it's interesting, isn't it? Because there's it's the tension that I mentioned earlier, where the EU's obviously trying to attract long-term capital into Europe, into its infrastructure, and does that through promising predictable long-term regulatory frameworks. But at the same time, It's what I mentioned previously, that in the last 10, 15 years, we've seen more regulatory tools being introduced rather than fewer. So the intervention potential has increased for the European Union then to get involved and potentially either block or have some sort of remedy in relation to investments. And I think the foreign subsidies regime, which I mentioned, it's a relatively new tool that was introduced in 2023, is a good example where the European Union introduced a notification regime for certain types of investment, and it was really trying to address the risk of an unlevel playing field where investors from outside Europe were investing into Europe with the benefit of non-EU subsidies. So it's effectively sort of state aid rules applying to companies outside of Europe. But what's happened is there's been this very large notification regime, lots and lots of notifications, more notifications than the European Commission anticipated, but literally a tiny number of interventions. And I think that calls into question whether that tool is really doing what the European Commission, European Union wanted to achieve. And there's already been some discussion that actually that notification process may need to change. So there's clearly some friction there that isn't needed, and hopefully the European Union will recognise that and then make changes to its framework.
Well, we've covered a lot of ground, and of course, as the Global Infrastructure Investor Association, our job is to be the voice of infrastructure investors. But there is another side to this equation, Jessamy, and that is, what do investors need to do? The people who have money to invest, rather than the governments who are competing for it. What's the most important learning from all of this for investors?
Well, I think being really clear about their needs is obviously really key, because we've had some incredibly valuable takeaways as part of doing this report. And there is this vast consistency across these regions as to what investors need to see. So I think for global investors, using every opportunity possible to articulate those is going to be key, because, I think it's been, we've been able to unpack very readily what that is. They need to know that there is predictable policy. They need to know that there is credible and consistent regulation. They need to know that timelines are, going to be realistically estimated and then delivered against, because ultimately that goes to the deliverability of the project. So those are the things that I think long-term, long-duration infrastructure capital is looking for. And I think they need to be very clear about that. So my takeaway from them would be that it's clear that capital will always find an opportunity, but it is willing to pay where it is matched with credibility. So being able to marry those two perspectives, I think, is going to be key to unlocking a lot of these investment opportunities.
And Alastair, perhaps a final quick one to you. You're in a lift, you're trapped in that lift with an investor. You've got to give them your 30-second elevator pitch as to what they should be doing. What would that be?
Look, I think in terms of from a regulatory perspective, it's being very clear on actually what the regulatory landscape is, which regulators you need to go and talk to, actually engaging with them up front, and trying to ensure you have as much transparency over the process as you can and understand what the risks are before you then go and actually make that investment.
Well, it's been fascinating talking to you both. It's been a privilege to work with Freshfields, to collaborate with you to produce this report. I don't think we've ever done anything quite like it before at the Global Infrastructure Investor Association. So I'd like to thank you both very much, Jessamy Gallagher, Alastair Mordaunt, both, of course, both your partners at Freshfields, for joining me. You can read much more on the topic of competing for capital by checking out the full report on our website at giia.net/competing-for-capital. And listeners, whether or not your organization is a member of GIIA, you can subscribe to our newsletter via our website, receive more market-led insights every month via that route, and do please follow us on LinkedIn for industry news and information about upcoming GIIA member events. If you aren't yet doing so, then you can follow Talking Global Infrastructure on Spotify, Apple Podcasts, or wherever else that you get your podcasts from. If you want to get in touch with us at GIIA, you've got an idea for another episode, or just to find out about membership, simply contact us at communications@giia.net. And that's it for this episode. Thanks very much for joining us, and we'll see you next time.